Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, I want to talk about 3 recession companies that in my opinion you should own if you haven't yet. These are great undervalued companies. They're also great dividend companies that have been giving dividends the past couple of years. So if you're interested in what these companies are, you want to learn about a little bit more about it, sit back, enjoy. Hope you like this video. If you do, please give it a thumbs up, share it to other people too if they want to learn about these companies. As always, please remember it's not financial advice. This is just me sharing. And if you're new to the channel, don't forget to hit the notification bell if you decide on subscribing, which I hope so. Without any more delays, let's take a look at these 3 companies. So the first company is United Health. Ticker symbol is UNH. This is a company that engages in the provision of health care coverage. So you can see based on their website, if you're not really familiar with this company, they do a lot of insurance plans, health insurance, Medicare. They also do like dental, vision, and supplementary plans as well as Medicaid. So let's take a quick look at Simply Safe Dividend. Simply Safe Dividend, based on their dividend safety score, they're rated as 99, which is very safe. Dividend yield is 1.30. It is considered a market cap. Looking at the key metrics, you can see payout ratio is 30%, which is very low for most companies. Forward payout ratio is about 28. During the recession, they have maintained their dividend on the 07-09. Looking at the dividend growth, you can see last 20 years, look at that, 39%, which is very fast. Last 5 years, 19%, which is also very fast. The latest is at 14%, which is very, very fast as well. You can see 2022 to 2009, you can see it's just flat. And then from there, it just went and skyrocketed up. 29 years without a reduction, 12 years of consecutive increases. Now, if you look at the payout details, you get paid quarterly in the months of March, June, September, and December. Then your annual payout is $6.60 per share, which breaks down, you can see from here, to about $1.65 per quarter, yeah? Looking at the dividend yield, you can see it's below the 5-year average, and then the PE ratio is 21, whereas the healthcare is 16. 52-week range is a little bit closer to the high of 548, the low is 387. Now looking at some of these stats, you can see total sales and then return on investment capital. You can see last 12 months 19%. Return on equity, you can see last 12 months, which is 24. Now if we go to tip ranks based on their analysis, strong buy, 9 buy, 3 holds. They have a price target at 594, which is a 16% upside. The high price target is in the 650, and then your average is 594, and then your low is 513. Now if we swing to the stock analysis, outperform, smart score, hedge funds have decreased, but then you have your consensus of strong buy and all that stuff. All right, now let's switch over to Yahoo Finance. You can see again, the low is 383, and then the high is 552. At the time of this video is 508. Now if you look at the 5-year mark, you can see that trend is upward. And so now if it looks a little bit more on the earnings, you can see beats for the past 4 quarters. And then look at this revenue. So you can see from 2018 to 2021, you can see a steady increase in the revenue from 2018 of 226 billion to 2021 of 287. Now if we look down a little bit more, you can see strong buy and a buy in September, and then it's a strong buy and buy. Currently it's in the low 508, and then the average is 590. Now if we swing again to Yahoo Finance, what I wanted to look at is the 5-year comparison between the S&P 500 versus the UNH. You can see it's been performing fairly better than the S&P 500, which you can see from here, and this is a 5-year mark. Yeah. Now if we swing to, again, Yahoo Finance, looking at the top institutional holdings, you can see Vanguard, they've hold a big chunk of these shares. You can see 82, BlackRock is 71, you got State Street Corporation 45, JP Morgan Chase 20. Look at that, it's in the millions, right? Okay, swinging now to Stock Rover. Based on their consensus, they rated as a strong buy, as you can see, and then the price target is in 650 is the high, 513 is the low, and then you got your 594, and then you also have your average EPS estimates and all these things over here. Now if we swing to simply Wall Street, based on share price and fair value, using what they call the discount cash flow model, their fair value is in the 804, currently is on 506, so they calculated this as an undervalued 36%. And then if you look at the overview, you can see these are the positives, and then this is the significant increase selling over the past 3 months. Now the second one I want to talk about is Proctor and Gamble. The ticker symbol is PG. One of my favorite companies to own. I personally have this in many of my different portfolios. As you can see, one of the brands, it's an iconic brand that you can trust in your home. You probably have this. Any products that you can see in here, probably you have this in here, from baby care to family care, hygiene. I have kids, so we've used the Pampers and then Bounce for the dryer. So you can see it's everywhere. Tide, just a solid company in my opinion, that many people use. Now let's take a look at Simply Safe Dividend. Based on their dividend safety score, they're rated as 99, which is very safe. Dividend yield is 2.77, and then it is considered a market cap. Looking at the key metrics, payout ratio is 61, forward payout ratio is 62. During the recession, they have increased it. And then check this out right here, 132 years without a reduction, just phenomenal. Last 20 years, 8%, last 5 years, 5%, the latest is 5. And then look at that, uninterrupted for the past 132 years without a reduction. So that's just amazing. Dividend growth streak of 66 years, consecutive increases. Your payout details, you get paid quarterly in the months of February, May, August, and November. Your annual payout is about $3.65 per share, which breaks down to about 91 cents per quarter. Looking at it, you can see a little bit higher. The dividend yield is higher than the 5-year average. And then here's the sector PE ratio. Looking down a little bit more, you can see some of the stats in here. But I want to show you the return on investment capital. 22% the last 12 months. Return on equity, 32% in the last 12 months. Now let's swing to tip ranks. Based on their analysis, they rated as moderate buy, a mixture of 2 buys and 2 holds. And then you have your 18% upside to about 556, with the price target high of 160, 156 is the average, and 149. Now if we swing to more analysis, you can see Smart Score outperform, and they hedge fund have decreased as well. Now let's take a look at Yahoo Finance. You can see 5-year mark. You can see it been up. It was going up and then it went down. Yeah. 52-week range, the high is 165 and then the low is 129. Now looking down to DC earnings, you can see a miss and 3 beats. And then if you look at the financials, again, upward trend. You can see from here it's an upward trend from 2019, 67% revenue, to the 2022 of 80 80 billion revenue, you know? And then you got your recommended trends of 10 holds, and then you got buys and strong buys. Price target is in the kind of in the low 131, and then you got your average of 155. Now let's continue looking at Yahoo Finance. So again, I wanted to see the performance based on comparing it with the S&P 500. You can see was doing pretty well, and then it got a flip-flop. S&P 500 kind of took over from 2021, and then from 2022, and then it kind of flip-flop again. If you look at the 2-year one, you can see S&P 500 was way better. And so now let's take a look at the top institutional holdings. You can see Vanguard. Look at that. Wow. That is huge of the amount of shares they have, as well as BlackRock. Look at that. And then State Street corporations. Look at that. And then pretty much everybody holds a big position in this company. So that tells you a lot. Now, if we swing to Stock Rover, their consensus is they're rated to buy. You can see breaking down, you have 7 strong buy. A month ago is pretty much the same. And okay, swinging to Simply Wall Street, and then you can see share price and fair value. Fair value is 219. 131 is currently rated it as 39% undervalued. And the last company I want to talk about is Waste Management. Ticker symbol is WM. So this is a company that engages in the provision of waste management. You can see, again, one of my favorite companies, one of companies that I currently own in my portfolio as well. Looking at Simply Safe Dividend, based on their dividend safety score, they're rated as safe, which is 74. Dividend yield is 1.59. Market cap is large cap. Payout ratio is 47. And then they have increased their dividend during the 07-09. Now, if you look at the dividend growth, look at that. The last 20 years, 31%, very fast. Last 5 years, 7%. And then the latest is 13%. You can see, again, upward trend. Uninterrupted dividend streak of 22 years without a reduction. Dividend growth streak of 18 years without consecutive increases. And then your payout details would be in the month of March, June, September, and December. Annual payout is $2.60, breaking it down to about 65 cents per share. Looking at it, it could be average is 5-year average is below now, and then on the return on investment capital 14%, return on equity 30%. Swinging to tip ranks, you can see moderate buy, 4 buys and 3 holds. With the high price target of 190, 171 is the average, and 160, 5% upside. Looking at the stock analysis, Smart's core outperform, and then they also have decreased the hedge funds. Now if we go to Yahoo Finance, you can see 52-week range, the low is 138, the high is 175. Looking at the earnings, you can see 1 miss, 1 met, and then 2 beats. And then the revenue, you can see much better from 2020 to 2021. You can see an upward revenue of 17 billion, whereas in 2020 it was 15 billion. Now if we look at the comparison, you can see the 5-year chart versus the S&P 500 has been performing better. So you can see from the chart right here. Now if we swing to Yahoo Finance, looking at the top institutional holdings, again, Vanguard, BlackRock, and then you got Bill Gates over here with 18%, State Street Corporation 18 million. You can see a big amount just by these companies alone, these institutions. And then you got Stock Rover, based on their analysis, they rated as a whole. It's been a strong buy, 2 strong buys. You can see 1 month ago and all that. So 2 strong buy, 1 buy, 8 holds. And then you have Simply Wall Street, Fair value is 205, current is 163, and then it's a 20% undervalued based on simply Wall Street. So that's all the three companies. In my opinion, these are companies that are solid, companies that are going to continue. I don't think they're going to get affected with the recession. I think people are going to continue to use these companies. Hopefully you like this video. Please give it a thumbs up. There's other great dividend companies that have also made videos out there, so please take a look at it. Alright guys, thank you so much for watching. Thank you for all your support. Please like and subscribe if you haven't done so. Please be safe out there, stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.